So welcome to Genus. We have these quarterly videos that we record and email out, but given what's going on in the markets, Wayne and I thought it would be a good idea to do weekly contacts with our clients. And so this is a Zoom recording. It's Wayne and I in our home offices. At the end of the day, it's 3:30 on Friday, March 20th. And we're going to do this weekly as we get through this. So please send in your questions. There'll be in the email you got this, there'll be questions at genuscap.com. So I'd love to use some of those next time. But this time, Wayne, I have a lot of my own questions. So and I thought we would just start with, is it possible to put what's gone on in the last month or so in some kind of historical perspective?
You know, it's basically a natural disaster effect. You know, I guess in terms of looking at events, maybe the Japanese earthquake about 10 years ago, but this is really big in terms of the impact to the globe. Maybe the Spanish flu in 1918 would be maybe a better analogy, but nothing in modern history I can compare. I can talk more about the market dynamics, but in terms of the event that's actually taking place, it's just, you know, we've hit an air pocket in the economy, and it's spurred a financial crisis, and we're trying to deal with 2008 type crisis coupled with a natural disaster.
Well, maybe I'll ask you an impossible, all these questions are going to be impossible, but best guess about the economic damage having been done, and some comments about the responses from the Fed and the central banks and the fiscal responses of the different governments. Are they doing enough? What do you think of the damage and the programs to try to address the damage?
Okay, I'll start off with this number, the sort of best guess numbers we're seeing in terms of forecast. This quarter is going to be probably down. The first quarter, not much. Q2 this year will probably be down 4 or 5%, and then maybe a flat Q3 and maybe a positive 3%er in Q4. So for the overall year, we'll probably be negative. But that's sort of the best guess in terms of we hit an air pocket. It goes through Q2 and sort of flattening out in Q3, and then a rebound as people come back into the market and start consuming things in Q4, latter part of Q3 and Q4. In terms of the response so far, all I can say is, thank God we lived through 2008, where the central banks and the federal governments had to enact amazing things and did. And it was I believe a bigger disaster then, because then the banks, every single bank in the world was frozen up completely. The European banks right now are in great shape. The American banks are in pretty good shape. Canadian banks are in good shape, and Japanese are okay. So there was nobody, the banking system is better off now than it was back then. So we've learned a lot. The Fed has come in and done everything they can do. They still have more to do, but it takes time. This has happened so fast, they can't solve the problem in a couple of days. So they're responding as fast as they can, and they're on the case. They're not going to go away. The job of the central bank is to stabilize the economy and promote growth and no inflation. We don't have inflation. There's not a problem here. It's promoting growth. So the bank is on this, and they're not going to go away. They're going to go down and buy. They're moving into the municipal market now, buying that. They're going to be buying corporate spreads. They're going to be buying things. The fiscal responses, we've seen the fiscal response in Canada, for example, it's about 3% of GDP. The U.S. one expected to be around 4 to 5% of GDP, which should mitigate. They got to get this money out there, get it fast, and they're pushing it through the Senate now. It's about a third of the way through the Senate. In terms of all the different programs, they're just taking piecemeal, approving them and pushing them through and getting them out there and getting them done. They will get done probably. They're shooting for $1 trillion to $1.2 trillion in the U.S., around 4 or 5% of GDP. I believe that's going to happen. They're really they're activated. They're on it. It's going to happen. So, but there's so many things that are moving so fast. They have to. It's a big problem. It's a massive problem to get all that money out there into. They're doing all the right things where they can. They're pushing back taxes.
My question, Wayne, they're doing all the right things. You think it's just going to take time?
I think they're doing whatever they can. It just takes time. But you know, this started a month ago, really. So it's been wild. It's
So
like,
I want to ask
like
you this question, but I kind of want to answer it before you do, because I think this is really important, is when will the volatility and the panic come out of the market? For me personally, the day that the globe has a decreasing number of new cases will be a big day for me. I think that that day, I think, is months away though.
I
What
think the market's
do
going
you
to do
think
that
might
before.
trigger?
I think the market is going to look through a lot of pain. I don't want to be, I don't want to be a mercenary here, but the market generally looks through a lot of pain. There'll be still a lot of pain on the street, and the market will be looking through it. It's like a war. I don't know when that day is, Leslie. I don't know. I don't know when it is, but it's going to happen one day where it's going to say enough. We can see our way through this, even with all the carnage on the streets. And it'll start discounting a recovery. I don't know when that is though, and it's probably going to get worse before it gets better here, I'd say. In terms of what we're seeing in the market, in terms of the market collapse over the past month, it's been breathtaking. It kind of reminds me of 1987, sort of a little slower moving 1987. 1987, it all happened in 2-3 days, was over, and you moved on. Here it's been a month, and whereas in 2008 it was like 3 months of getting beatings every day. Here, it's happened very quickly, and the correlations across the market have been just amazing. The average correlation of stocks across the whole market have been around 90%, which means stock picking doesn't do you any good because everything's going down the same speed. Actually, the past couple of days, we're getting down to the range here. We're starting to see some value players, bottom feeders come in and start picking away at the market. And today was the first day in actually a month where we saw value stocks start to outperform. They've been so beat up, they're starting to bounce. And so that's a good sign. We can start getting at least a discussion going on internally in the market in terms of people buying and selling different stocks. That's a good thing, except, apart from everybody running for the door. So I'm looking for a little bit ray of sunshine here. That's one I've seen through the course of the past couple of days.
So some rationality, some analysis coming back into the market.
Yes. Yeah.
So tell me about corporate bonds in this kind of environment. What happens there?
Well, corporate bonds right now, they're going no bid, basically. People are kind of backing away. They backed up, rates have backed up around.
And why does that happen? Like, why does that happen?
I just think it's a lack of liquidity. There's no market makers. The market makers are gone into their hidey holes, Leslie. They just, and it's it's not a deep market. The corporate market in Canada is not a deep market, and the dealers aren't going to stand behind it. So we have to wait for this problem to the whole thing to unwind. It will at some point in time. We anticipate spreads will go a bit further here, but remember, government bonds have been falling, so they've been falling fast, and the corporate bonds haven't kept pace. That's helped mitigate some of the losses in the corporate side.
Right.
So we still think there's more pain to come here in terms of a buy for corporate bonds hasn't happened yet, but the short end of the corporate bond curve has moved a little further out because there's been more activity there, which is very unusual. So it tells you that maybe the long end is going to move a little further out in the coming weeks, I would say.
So what do you mean it's gone further out?
The short-term corporate spreads have moved further than the
spreads.
The long-term spreads.
So that happened in 2008 too, just to remind our clients, it became an enormous spread between governments and corporates as risk was perceived to be really high. And we took advantage of that in January of 2009. That's when we started our corporate bond fund to take advantage of that. And so we'll hopefully add to our positions when the spreads get really wide. But that's a ways away from now. I would like to just remind people that nothing to do with the virus, but in January of 2020, we launched a global bond fund, really a US bond fund, not because of the virus, but because of the Canadian election and the obvious dissatisfaction of the Albertans with the rest of Canada and fear of succession talk, not succession itself. But we wanted to get money out of Canada and not into more US stocks. We had our full weighting in US stocks. So we launched a global bond fund in January. It's only 5-6% of people's portfolio, but it's been the best performing part of our portfolio. So we're happy about that. Well, Wayne, tell me more about what changes you've done in the portfolio in the last week or so.
Okay. Well, let me just back up. Yeah, back up a little bit here. When the when the virus broke out of China, we started raising cash in our equity funds, and that primarily came from the more economic sensitive areas. Obviously, we started reducing Canada. We were concerned about oil. Obviously, we took some oil stocks off the shelf, and we also removed some of the cyclicals, companies like tech. Reduced some companies we had like Gibson and Parex in the oil side, and started reducing some of the banking exposure, especially the insurance companies. We reduced Manulife, for example, was one we reduced. Some MetLife as well, because those companies don't do well when you have interest rates collapsing the way they were. So we reduced financials and energy in Canada. Went about 5% underweight Canada at that point in time. And when the market kept going down, we started picking away. We also sold a company out of Europe called Safran that is involved. They're one of the vendors for Boeing. They're going to be hit, obviously. And as the market came down, we started going back in, and started picking away at companies that will do well in this kind of environment. Companies like TELUS, Walmart, Target, Verizon. There's going to be companies that are going to benefit from this move, this social distancing, and they're all primarily, companies that deliver food, infrastructure, and technology. We've been overweight. We've also been increasing technology companies. We have a lot of exposure to semis, and we've also increased our exposure to Amazon as well, Tyson Foods. And so we're looking at right now we're focusing on companies that are going to win during this current environment. And one of my takeaways from this current environment is that this is going to change how companies and society does business, I think, for a long time. I think it's going to accelerate. My one takeaway, this is going to accelerate the move to the digital economy. And that's what we're doing here right now. So we're not going to stop doing this, folks. This is just a trend that's beginning. And so we're going to focus on those winners. There's going to be more digitization and more digital working, remote working. And our teams at Genus are using Slack, and they're using Zoom, they're using Hangout, and everything's running just fine. Technology does work well. We're as productive as we were.
I just thought I'd throw in so our clients know there's about 30 people work at Genus, 30 plus, and none of us go to work, like none of us. And we haven't had any operational problems. The switchboard operator, a receptionist, works from home. So you can call our switchboard, you wouldn't know that. So if this had happened 5 years ago, I don't think we could have done that. We've bought a few more licenses for different things, but really it's been unbelievably seamless. So I just thought
that's true. And I'm really hoping that because of that, the impact of technology and Amazon delivering goods and things like this, that we might get a surprise on the upside here in terms of what expectations are, crossing fingers.
We're not social scientists, so we shouldn't dabble, but it truly is interesting what our lives will look like when we come out of this, because, I mean, really, I don't want to, as I say, dabble in social science, but something's going to change for sure, and I think it's going to be for the better and better for the environment. I want to keep this relatively short, Wayne, because we're going to do it every Friday afternoon, and please call your portfolio managers. Don't suffer in silence. We've been reaching out to a lot of clients, but we may have missed you. You have an individual plan that works with all what's going on, and we want to remind you of that. So please give your portfolio managers a call if you aren't feeling comfortable. And we'll talk to you next week, and please send in your questions. Thank you very much. Thanks, Wayne.